Happy Wednesday out there, folks. This is Darius Dale here to present our macro minute for Wednesday, August 17th, 2022. Starting with asset markets, we have stocks down this morning, commodities mixed, crypto down, dollar up, global bond yields up. Market moving headlines. We got we're bird watching for doves today. So you have U.S. futures down, the dollar's up, the treasury yields are rising as investors await the minutes of the Fed's last policy meeting for clues on policymaker sensitivity to weaker economic data. As we've heard from many Fed head officials since the famous Powell non-pivot back on July 27th, very clearly inflation is still the number one and really, quite frankly, the only mandate, if only because it's been supported by some resiliency of growth data. Speaking of resiliency, you got a decent enough retail sales print this morning. So they stagnated if you look at it on a headline basis, which was restrained by sharp declines in gasoline prices and auto purchases. But you also had a pretty big jump in core retail sales that rose 0.7%. So you're seeing a resilient consumer, particularly in the face of declining energy prices. That continues. Obviously, you're going to get that's something we talked about in our research, going back a few weeks ago in terms of outlining the broadening distribution of probable outcomes with respect to inflation and how that may feed through not just to Fed rate expectations, but also to rising growth expectations as you deflate inflation and inflate real incomes, real GDP, everything real, et cetera. Shifting gears here, what you sell and who you sell it to mattered most during the Q2 earnings season. So Target's profit badly missed consensus, and the company ratcheted up its pressure on the second half by sticking with its forecast for a dramatic rebound. So the old miss and punt it to the back half. Target is pulling. It's obviously not working. You had Lowe's disappointed as well too. Comp store sales fail, and the company now expects full year performance towards the bottom end of its previous guidance range. So again, not the same dynamic we saw at Walmart, certainly not the same dynamic we saw at companies like Apple and Amazon, but we are seeing an increasing amount of dispersion at the single stock level as the economy no longer goes from a situation where rising tides lifted all boats to now you actually have to have a pretty solid boat to sail on a little bit more choppy economic waters. And then lastly, I thought this is a pretty interesting valuation signal, certainly not something I've seen in my career, so I just wanted to share with you all. But allegedly, there's this sort of rule of 20. So Bank of America put out this note saying that there's an indicator with a perfect track record, at least since the 1950s, when you add up the S&P 500's trailing PE ratio plus inflation. Historically, when you've seen a bear market bottom, that ratio or that sum, the PE ratio plus inflation, has always been below 20% or 20. We have not seen it fall below 20 this year. It only got to 27 at the lows in June. So clearly there's a valuation-based argument that this market is overdue for a pullback, potentially overdue for a retest of those lows in the context of the lagged policy impact of tightening still filtering and flowing through the system, and ultimately what that might mean for corporate earnings through the operating margin channel. So been saying this in our research, probably don't get it as clearly and cogently on the macro minute, but certainly the distribution of probable economic outcomes has now flattened as wide as I've seen in years. And as a function of that, the distribution of probable market outcomes are about as flat as wide as we've seen in recent years. However, we're a lot closer to pricing in our bull case scenario than even our base case scenario, and certainly not our bear case scenario. So just be aware of that as an investor. Big movers this morning. So you had pretty hot inflation print out of the UK economy, accelerating there to, I want to say, 40-year highs on headline CPI, 30-year highs on core CPI, 50-year highs on output PPI. Is dragging up rates across the UK curve. So British pound 1 year, 1 month forward, overnight index swap forward rates up 28 basis points today. A full rate hike priced into the 1 year forward rate curve in the UK. That's at 3.49%. It's up 56 basis points month over month. Dragging up 10-year UK gilt yields up with it, up 16 basis points to about 2.29%, up 20 basis points month over month. And then lastly, dragging Europe's having sympathy as well in terms of what that might mean for forward-looking inflation data in Europe. So the euro 1 year, 1 month forward, overnight index swap forward rate up 22 basis points day over day to 1.64%, up 24 basis points month over month. So still moving in the wrong direction from the perspective of the global liquidity cycle, which is something we've observed, at least through the policy rate channel, through the money market, rates here in the U.S. of recently. Have not necessarily observed that in the net liquidity function, but it's something we'll be talking about in our research as well. It's very likely that we will start to observe that, and that's partially why you're seeing a bounce in the dollar over the last week or so. Getting into our volatility, adjusted momentum signals and probable ranges. U.S. dollar index, that is bullish FAMs. kind of in the middle of its range there. Gold bearish fans finally backing off, backing off the upper bound of its probable range, got 2% downside, 2% upside, so somewhat fair fight in gold for the first time in a while. 10-year nominal treasury yield neutral VAMs, middle of the range. High yield credit spreads broke the bullish VAMs on the volatility signal here. So it's getting a little bit more volatility in fixed income filtering through to high yield credit spreads this morning. You got about 12 basis points of downside versus 53 basis points of upside. S&P 500, that is neutral VAMs, backing off the upper boundary of its probable range. We got 1% upside, 5% downside. VIX bearish VAMs still in the middle of the range. NASDAQ 100 broke the bullish VAMs this morning on the volatility signal. You got about 3% downside versus 4% upside in the probable range there. Russell 2000 bullish VAMs. We talked about that yesterday in terms of the pro-cyclicality of sector and style factor dispersion. Is something we would be explicitly fading, and maybe even as an investor, certainly heading into the next 3 to 4 or 5 months, where the market regime, or not the market regime, the macro regime is likely to transition to deflation. That's where growth slowing and inflation slowing. You typically get pretty persistent underperformance of cyclical sectors and style factors in that setup. Bitcoin bearish VAMs got about 4% upside, 10% downside. Ethereum bearish VAMs about 2% upside, 18% downside to the lower boundary of the probable range. Shanghai Composite neutral VAMs getting close to the upper boundary, about 1% up there to the upper boundary versus 4% downside. WTI crude oil neutral VAMs getting close to the low boundary of the probable range, 4% downside, 16% upside. And then lastly, ag bearish VAMs backing off, got about 1.6% upside, 6% downside. Industrial metals bearish VAMs backing off as well, got roughly 3% upside, 7% downside in its probable range. So with that, Darius Dale presenting our macro minute for Wednesday, August 17th, 2022. Best of luck out there today.